Welcome back to the channel, everyone. We've got some exciting news. I've just invested $10,000 across 2 stocks, and today we're going to cover what stocks I've acquired and some of the reasoning behind why I'm buying these companies, which will include a high-level assessment of their fundamentals, prices, and future growth. Let's jump straight in. So the stocks I've bought are Google and Medpace. I've increased my position in Google by over $6,000. This takes my total position in Google to just over $22,000, making it now the largest position in my portfolio, overtaking my position in Fortinet, which is $19,000. I've also bought $4,000 of Medpace. This is a new holding in my portfolio and is currently my 9th largest position. I'll dive into both companies and cover what they do, their fundamentals, their price metrics, and their future growth drivers. I'll be using my investment analysis platform to analyze their fundamentals. If you want to follow along, you can try it out for free. The link is in the description. So Google doesn't need much of an introduction. Their primary revenue streams are from digital advertising and subscriptions, primarily driven by search, YouTube, and cloud services. Google is the leader in search. They're the 3rd largest cloud computing provider and one of the largest players in online video, with YouTube ads generating a staggering $10.4 billion in the most recent quarter. To put that into perspective, that's more than Netflix's total revenue of $10.2 billion for the quarter. Looking at their fundamentals, Google's revenue is up 14% for 2024, reaching $350 billion. This growth was fueled by continued strength in search, YouTube, and particularly Google Cloud. Drilling down into the performance of the individual segments, search and YouTube revenue has grown around 10% compared to last year. Subscriptions increased around 20%, and Google Cloud posted impressive growth of around 25% compared to last year. Earnings have also soared over 30% to $130 billion, driven by improved margins. Google is doing a lot of capital expenditure, so I think some of this growth is being hidden when looking at the movement in the free cash flow. Google has announced plans to spend $75 billion on capital expenditure this year, with a large portion of this going towards cloud and AI infrastructure. That's around a $23 billion jump from the $52 billion they spent on capital expenditure in 2024. There is uncertainty around what the return on investment is going to be on this capital expenditure, especially with the recent announcements like the release of DeepSeek, indicating that AI models can be trained at a fraction of the cost. I think that this is partly why Google's stock price has dropped around 9% from its all-time highs. Their earnings and free cash flow per share over the past 5 to 10 years have grown at a compound annual growth rate of around 20%, so strong historic growth. Price has also grown at a compound annual growth rate of around 20% over the same period. In terms of future growth, I think Google can continue to grow search and YouTube revenue at a similar rate to what it has done in recent years. I think cloud and AI services have a long run rate to grow. There are still a lot of businesses that are yet to move to cloud. Google centralizing this function, driving efficiencies and cost reductions through economies of scale, integration, and offering of new services should aid in driving adoption, so I think we'll continue to see double-digit growth in the near term. Google is competing with Microsoft and Amazon in cloud. In Q4, Google's cloud revenue increased by 30% to $12 billion, which is significantly faster than the overall cloud market. Microsoft's Azure grew around 30% as well, and Amazon's AWS only grew 19%, so Google is showing incredible momentum that's comparable, if not better, than some of its competitors. Looking at the price ratios, normally I'd look at the price to free cash flow, but I think it's being skewed by the current capital expenditure, making the stock look more expensive than I think it actually is. So we'll look at the price to earnings ratio in this case. Looking at price to earnings, it's currently sitting around 23 times, which is at the lower end of where it has historically traded. We can compare this to a company like Apple and see that Google is trading at a price ratio half that of Apple, despite Google showing stronger revenue, earnings, and free cash flow per share growth than Apple. Google's price to earnings ratio is also lower than the ratio for the S&P 500, which is currently sitting at over 30 times, so cheaper than the market. Overall, I think Google will see similar growth over the next few years. I don't think the current levels of capital expenditure will be sustained and will start to normalize in the next 2 or 3 years. I also think Google is trading at a reasonable price, lower than its historic rates, most of their competitors, and the S&P 500. So overall, I think reasonable value for strong growth. I also think it offers one of the best growth profiles for its price out of the companies I already own, which is why I'm increasing this position. Next is my new position in Medpace, which I have invested $4,000 into. This is a position that super investor Terry Smith has recently entered into as well, though it is a small position in his portfolio, making up less than 0.5%. Medpace operates in the healthcare sector and offers end-to-end research and development services for pharmaceuticals and medical devices. So they centralize and standardize the development and testing processes for a large number of pharma, biotech, and medical device companies. They operate in over 40 countries, so they have a global footprint. I don't see any reason why they can't open more labs, expand into more countries, or offer services to more clients, so I think they have room to grow. The share price is currently down by around 10% over the last year and down more than 20% from its all-time highs. Short term, there are some cancellations and project delays, so management is expecting slower growth in the near term, which I think is driving the price decrease. Management is expecting revenue growth to pick up in the second half of the year and normalize thereafter. They have maintained fairly consistent double-digit revenue growth. Over the next few years, I expect that they will maintain a similar level of revenue growth. Operating at scale, management is able to optimize their processes and costs, which should further drive margin improvements. Their earnings and free cash flow per share over the past 5 to 10 years have grown at a compound annual growth rate of around 20%, so strong historic growth. Price has grown at a compound annual growth rate of around 30% of the same period, so price has grown a bit faster than earnings and cash flow. But I think part of this is that the company was trading at a price to free cash flow of 14 times, and this has now expanded to around 18 times, which is still a lot cheaper than the market and most of the companies I've seen. Medpace is also trading at the lower end of its historic price ranges. Comparing Medpace to Google, we can see that Medpace is growing revenue, earnings, and free cash flow per share at the same rate, if not faster than Google. Medpace has lower margins than Google, but has higher returns on capital, with returns over 35%. Looking at price ratios, Medpace is also comparatively cheaper than Google. In summary, looking at both Google and Medpace, I think they both have strong fundamentals. Both are growing earnings and free cash flow per share at a compound annual growth rate of around 20% over a 5 to 10 year period, which is strong growth. I expect that they will be able to maintain similar levels of growth in the near term. Both are trading at low price ratios compared to their historic ranges, competitors, and compared to the market, and think that they offer good value for their growth. That's it for this episode. Let me know in the comments what stocks you're buying or watching. If you found this analysis insightful, hit that like button and subscribe for more stock investing news and tips. I'll see you in the next one.